Okay, I think we're gonna start. So, thank you all for attending our latest webinar here with SIMBA Chain. We have a very special edition for you today. We're covering a hot topic: central bank digital currencies, and we have a special guest here, Vipin Bharathan from Forbes magazine. It's an honor to present with him, and I'm glad that he was able to come by and join us today. So, before we get into central bank digital currencies, I wanted to give you an example of that's really general to technology and the innovation cycle, and more generally. And this is a quote that Mark Cuban gave that I heard him give on a podcast. I'm slightly paraphrasing, but not paraphrasing by much. And he said, in the early stages, all of my successful ideas were initially called crazy. And then, of course, they became big. Now, I think the challenge here, just thinking about this, is that ideas that go big are initially almost always, maybe not always, but almost always called crazy in the beginning. The challenge, though, is that is only a subset of a larger group of ideas, which is stuff that people say are crazy. And, when you've got any type of new technology or any type of new initiative or new trend, it is hard to distinguish between what might be here, and my cursor, the smaller circle, ideas that go big, and what might be in this larger circle of stuff that people say are crazy, especially when this better group is entirely encompassed or almost entirely encompassed by this larger superset. The good one is a subset of a larger one, which isn't necessarily have all the ideas that are good. Stuff that they may be good, but not necessarily ones you want to take a big bet on. And so, how do you navigate something like this? And how do you distinguish between the smaller subset and the larger superset? Well, it may be helpful just to think back to this classic technology adoption life cycle. And this goes back to Geoffrey Moore's kind of famous book that came out in the early 90s, and he's been updated several times since then over the last 30 years. And it's a timeless book called Crossing the Chasm. And although the focus of this is technology, you could apply this to really almost anything, but it certainly applies most to technology or technology adjacent concepts. And so, in the beginning, it's largely this very small group of innovators and enthusiasts that are driving the usage, that are driving the discussion, that are driving the trends. And then early on, you get these early adopters, and these are, closer to the mainstream, but they're still visionaries. They may not be ultra enthusiasts or specialists or innovators in that understand the technology at the deepest level, but they see the vision of what is possible, and they're willing to kind of make that leap. The hardest part is being able to cross the chasm from the visionaries to the mainstream and the pragmatists. And many companies try, and as well as industries try, but only some are able to cross the chasm. Others kind of fall in between, and that's a tough one to cross. The challenge right now with any technology, but I would say especially, and I'm not really talking about CBDC, central bank digital currencies, but speaking of Bitcoin and cryptocurrencies and blockchain in general, is that we're in these early stages. And so, in these early stages, the discussion is driven by enthusiasm. And it is precisely because of their passion and enthusiasm that they're able to bring this technology to the next stage. They're able to kind of see what is possible and tinker with it and play with it and do what's necessary. But it's also that same enthusiasm that makes it hard to distinguish between what is real and what is maybe ephemeral or not real. And with crypto and blockchain, I would say that these characteristics is further accentuated because you have a lot of passion that's driving. You have community and even forms of identity that people take on, like with whatever, for instance, crypto coin they follow. And another thing that makes it very difficult in the beginning is that it's a new technology, and so there's an especially high degree of specialization that's required to understand it. Okay, and the returns to specialization that we've seen across the economy are even more present in crypto and blockchain because of the very nature of it. This combination of interlocking abstract concepts that make up blockchain and crypto, that makes the returns of specialization even harder. So for somebody who's not in this this tiny left-hand kind of edge of the curve, or even in, even any of these, either the visionaries or tech enthusiasts, it becomes difficult because you've got a high degree of specialization that's required. There's a lot of enthusiasm that's driving it, which makes, separating the signal from the noise all that more difficult. All of this accentuated by, of course, modern social media with viral memes and narratives that can, add to the discussion. And I would argue that the last year of pandemic and being stuck in kind of social distancing has emphasized this even further, because we're spending more time online, more time in online communities. And so for somebody who's not there, like, how do you make sense of this? And for me, what's worked for me is going out and finding people that are able to traverse various levels of abstraction, that understand things that have worked and have experienced, that have experimented, that understand the ultra big picture and the possibilities, but also can understand something at a really, really granular and a tactical level, and then be able to tell those stories at those various levels of abstraction. And I was really lucky that, at least when it came to blockchain and crypto, and certainly central bank digital currencies, I found that person, and he's here with us today. So a special guest, Vipin Bharathan. This is a really short bio. His bio is much longer than this, but I pulled out what was, the most relevant parts to us. And then first, he's a Forbes magazine contributing writer. Been writing about central bank digital currency since, I believe, the middle of 2020. Written a prolific writer. I encourage you to check out his writing. But prior to that, unlike many people who write for venerable mainstream publications like Forbes and others, he spent decades at various global banks, BNP Paribas, where he was the blockchain lead for North America, the first ever. But his roles also included, software engineering, like hardcore software engineering, technical architecture, and leadership. And I would surmise to say that there's probably not many writers in venerable publications like Forbes that have also spent years as software engineers. And so that gives to me an understanding of being able to cross and iterate across different levels of abstraction that's really important. And he's also, vice chair chair and founder of the Capital Markets Working Group at Hyperledger, where we met, and interoperability work stream at the Digital Global Currency Initiative. So that's just a little bit of a quick intro to Vipin. So Vipin, welcome, and thank you for coming on and joining us here. You ready to talk about central bank digital currencies?
Yeah, I could go on all day, but we have only about, what, 50 minutes, 45 minutes, whatever.
Yeah, we are, and we're going to switch. If you bear with us, we're going to switch presentations just really quickly, and we're going to move on to our other deck. And here you go.
And before that, I want to say thank you to Anjon and also to SIMBA Chain. I wasn't aware of SIMBA Chain until I met Anjon, and I believe that a company like SIMBA Chain is what we need now, which is basically help us cross that chasm, put that bridge over the chasm, because they are operating at a high level, at the application level, and they take out the differences between the different DLTs, between the different blockchains, allowing you to write, think about the important things, like what is your solution going to do? How are you going to manage it? What are you going to do? So SIMBA Chain is at the right level of abstraction. The second thing is they've got all these government contracts. People think, oh, government contracts, it's easy to get, but you have to go through a rigorous process, very rigorous process, more rigorous than private companies that I've worked for. In fact, some of the more interesting things like capability, maturity model, even the internet itself was sprung out of deep work in the government. So I was very impressed that they're representing, doing applications with the Air Force and things like that. So thank you for having me, and it's a great honor to present.
Thank you. Well, that was unexpected. So thank you, Vipin. So, we're going to do today, and then I'm going to hand things over to Vipin. We'll be co-presenting here. Is we're going to start with an overview of what is a central bank digital currency. what are CBDCs in terms of how it impacts on payment systems and gives you policy, monetary policy, and policy agility. Vipin's going to do a quick synopsis of the BIS Innovation Summit, a couple of weeks ago. The BIS is the Bank of International Settlements. It's over in Switzerland, and it's kind of what I would say. It's kind of commonly called the Central Bank of Central Banks. It's a consortium of central banks. So really interesting in terms of what they covered, and Vipin's going to share some of his thoughts from attending that conference virtually a couple of weeks ago. We're also going to talk a little bit about stablecoins and CBDCs and how they are, it's not the stablecoins, it probably deserves its own webinar, but it is an adjacent concept. It's very relevant. And we're going to touch on that. And we're going to talk about some examples and pilots. So with that, please do keep the questions coming. We will occasionally take questions during the course of this webinar, but we're going to leave most of them for the end because we want to get through our content, and we do have quite a bit of content to get through. So we may be very, very selective with what we take because the priority is to get through the content and to get to your questions. So with that, I'm going to move it on, and let's get to the next slide here. Bear with me. There we go. So a little bit about let's start with the very basics here.
Yes, this is the very basics. There are two people, someone who wishes to purchase something from somebody else. In my case, I would say I'm going to go to a pizza place and buy a slice of pizza, and I am the payer. The pizza clerk, the one who's taking my money is the payee, and I'm just using cash. There's nothing obscure about this transaction, but there are a lot of concepts embodied in that transaction, which Anjon will go to when he advances the slide. He'll show that cash is legal tender. It can be used for a peer-to-peer transaction. Cash doesn't have any interest. It is anonymous, meaning I leave the pizza place. The pizza, the cashier does not know anything about me other than I showed up. So it's a physical token, and it also needs a physical presence in order to do it. But the most important piece of it is that it is and of course, there's no recourse. That means there's once I pay, get my slice, and walk out of the store, I can't come back and start demanding my money back. I can, but really speaking, it is the equivalent of DVP, delivery versus payment, which everybody talks about. So that's that. And then the next concept is that it's a liability of the central bank. That's what makes it very, very safe. That means the person, the pizza shop owner, can take that cash that I gave her and bring it to some other place and buy flour or tomato sauce or whatever you need to make pizza, and also of course to pay the employees and things like that. So it's a very simple transaction, but above that is all of this the 6 or 7 features. We have just picked 6 or 7 features. There are other features, but we won't go into that. Yeah. The next slide. Yeah. Okay, so here we have now the same transaction happening using checks. So I go to the pizza place and I pay with a check. First of all, they are not obliged to take my check. They can say I don't take checks. But if I'm a frequent visitor and they know me, they'll take my check. So we are trying to see what are the other intermediaries that are required to make that check into something that the pizza shop owner can fully custody and use. So we see here that the payer's bank is involved. That's my bank, who will then the payer's bank will present the check to the payer's bank, and in the end, the settlement system is real-time gross settlement, which is also a feature of the central bank. So these are the characteristics of the check that is different from cash.
Yeah.
It could be legal tender. There could be transaction costs if it is not a check, but if I use a debit card, for example, it can be done over the phone, or well, with a check you cannot do it because it's a better instrument. But if it's a debit card, I can do it. It is not anonymous because now they know my, they have bank account information, the payee. It is a physical token, the check, but if it's a debit card, it's not. And there is no physical presence needed if it's a debit card. And there could be a recourse. I could stop the check. I could dispute if the payment if it's a debit card. So go ahead.
Yeah. And
anything to say? Anything more to add?
Yeah, what I'd add is that there are, at this point, as soon as you move out of cash, you're dealing with intermediaries at that point, and you're dealing with other features. And there's advantages, of course, is that you don't need to have physical presence. You don't need to have, it can be entirely, electronic. You don't need a physical token to do this. The no recourse, that's both a bug and a feature depending on your, your standpoint. There's no recourse. There is recourse. So that is another characteristics. You lose the peer-to-peer aspect, and you have intermediaries. You have, at least at a minimum, you got the payer and payee's bank, and then there's an entire settlement system, which you're summarizing here, that exists between the bank. And so there's a lot of players involved, and that leads to other issues of costs. The other part I think is really important to state here, and this is going to be important to the next slide as well. We're going to go to credit cards next, is that not everyone has access to that for various reasons. Retail banks, there's significant parts of the population that are unbanked. A surprisingly significant part of, even in advanced economies like the US and the UK, significant part of the population, I don't know what the numbers are, unbanked or underbanked. And if you count underbanked, you're looking at something upwards of 15 to 20%, according to some studies. And if you go to developing countries, that percentage is much higher. And so not only are there intermediaries, not only are there costs and there's times, but to simply get access to this system, there's a barrier to entry that, especially in developing countries, but also in advanced economies, not everybody has access. And there's a barrier to entry there to be able to get the convenience here. And I think it's important to state that. And that'll be even more so the case, I believe, with our next example here, with credit cards. So Vipin, we can talk about credit cards.
Yeah, I mean, all it means is piling on of intermediaries and card networks and other networks and other agreements, but it also comes with increasing costs, 3 to 5% of every transaction. We may not be paying it directly as customers, but we are indirectly paying it because the merchants are passing that on to you in some way, shape, or form. But in the end, the settlement happens on the central bank rails. So going back to all the slides, the top layer, the final layer is the settlement happening at central bank. Yeah.
And I think the other, this has even more intermediaries than the previous example, but you're right, settlement's still happening at the central bank. And it's also important to include that here, the barrier to entry, the barrier to adoption is even higher than it is for banks. So, there's significant parts of the population that will not qualify for various reasons for retail bank. They'd be considered, too risky for the retail bank, or not profitable enough customers, or at least not profitable enough without avoiding, consumer protection laws, et cetera, et cetera. So banks simply opt out. In credit cards, that's even more the case. Credit cards are tremendously convenient, of course, for those who qualify for them. But if you don't qualify for them, then you're completely locked out. And even if you do qualify for them, as Vipin, as you said, there's a lot of transaction costs involved with that. and that 3 to 5%, and then that's not nothing, and that's purely for domestic.
But remember, this 3 to 5% is on every transaction, which
Yeah.
is totally different. It's like you're basically putting it on top of every transaction.
Yeah. So that's a cost you pay for that convenience, even if you qualify. Yeah.
Yes.
Because yeah.
So go to the next slide, please.
Yep. So what are we? So this is the next slide. Let's go. Bear with us here. Payee.
Here is the same situation, but simplified again with a CBDC, which will act very much like cash. So no physical token. It doesn't need a physical presence. It can or cannot be anonymous. It is a dial that can be set. And usually there is no recourse. This is not like a credit card. And you can do a peer-to-peer transaction, or otherwise it can be a token or an account-based system. And as far as the legal tender, there has to be legislation that creates legal tender status for CBDC. In China, for example, they have done it. In other places where they have put in, they have deployed CBDCs, this is the case. Anyway, go ahead.
Yeah, I think what's interesting here, Vipin, is that you get it is in a peer-to-peer transaction, so you're getting many of the benefits that you get from the electronic payment system. You get many of the benefits of not needing, for instance, a physical presence, physical token. You get some of the, yet it's still the peer-to-peer. You could do this without nearly as many. It could be a more streamlined process in terms of intermediaries. So you get some of the benefits of cash as well. So you get some of the benefits of both and functionality of both. That doesn't necessarily mean this would replace the others, but that it is another option that's out there, another rail that's out there, that will complement the existing rails that are already there.
Yes.
Yeah.
And we should go and say that, of course, this is also a central bank liability of the central bank.
Yeah.
Because CBDC is nothing but central bank digital currency. So central bank issues the currency. It's the safest asset in terms of a national system. Many people who are maximalists on the Bitcoin or other side may disagree, but currently, 99% of the people use central bank money in some way, shape, or form. Anyway, go ahead. Next, maybe we should. So it brings us back to the functions of a central bank, which is basically the effective operation of an economy in the public interest. This is from the Fed. It's similar statements from all central banks. The points that we have highlighted here, which is the payment and settlement system safety and consumer protection, which Anjon mentioned, and community development, these are part and parcel of the central bank's functions because it is in the public interest. And so a CBDC would be very much in keeping with the current functions of a central bank. It is not outside the remit of a central bank. That's the thing that we have to understand. It is just a continuation of their normal functions and their normal, expectations of what a central bank should do.
Yeah, and so those bottom two that you've highlighted in bold, that's where the CBDCs are really relevant to the current big picture mandate of the central bank. And this is specific to the US Federal Reserve, but central banks are largely analogous. The major central banks are largely are basically analogous to what the Fed's mandate is in the US, more or less.
Yeah, I mean, although all those two points are highlighted, it also has effects on all of the other points because, for example, systemic risk can be more easily monitored if it's a digital system, and there are some ways to monitor that, stability of the financial markets and so on. We didn't even go into the whole interest rate question, whether because cash has a zero lower bound, that means if you're holding cash, you're not going to get any interest, nor are you going to pay any interest, like negative interest rates, which is common in Europe. So there are thoughts as to whether there should be negative interest rates on CBDCs, which is not yet. These are some of the questions that people are studying.
Yeah, or have any type of interest, positive interest rates, because cash pays none. There is, at least in theory, a potential that you could design a CBDC, and these are design questions really, that did pay positive interest too. And right now, cash is not interest bearing at all.
Yeah, I mean, these are the questions that we have to balance when we look at the risks, which we'll come to soon.
Yeah, fabulous. So we've touched on a lot of this already, but I think it's important to go through, like, what are the main rationales, the value of what a CBDC provides? And we've touched on this, throughout, but it's important to like do a summary. It's a twin of cash, right? It's a digital version of cash, and cash itself is very long pedigree, right? And you go through, payment system as a national infrastructure, payment diversity, you mentioned that, having multiple pathways, having multiple rails, because, having, not just diversity, but rail diversity, I would say. So, Vipin, offer some of your more thoughts here. But I think this is a great summary of some of the major rationales of why you would want to do, why a central bank or treasury or finance minister, we were called Treasury Department in the US, or Chancellor of the Exchequer in the UK, why they would be an interest in putting out a CBDC, a central bank digital currency.
Yeah, the fiscal policy side is also emphasized here, like the QE to the people. Well, you can think of it in a very broad sense. Any kind of benefit payments from the government, Social Security, universal basic income, even the pandemic, the SBA loans and so on and so forth. All of these exposed the perilous and the powerless state of our payment systems, because some people received payments that they should not have. Some people did not receive payments in time, and also there was a lot of delay. And of course, these other questions of financial inclusion, government is not going to discriminate between people when it comes to giving them, let's say, digital wallets for small amounts, or between the young and the old, which is a very interesting question, because right now you got, banking can only be done by, in the US, you can only directly get a bank account only if you're above a certain age. Otherwise, you're basically just a delegate. I mean, you delegate your parent or a guardian to do that. But cash can be used by both young and the old. And so is there a way to have CBDCs in small amounts be used by the young in a wallet? These are all questions. And it comes up even in the BIS summit that we will talk about later. Cross-border payments, of course, and central banks are being pushed by people like, the Facebook DM, which would have lost control of monetary policy for governments if it gets widely used, because there are, of course, 2 billion users for DM, more than any nation state.
Yeah.
So that's another reason. The last one, of course, is physical custody, issuance, distribution, and even for a small businesses to keep and track cash is a very costly proposition.
Yeah, and yeah, I think the two kind of takeaways I'll have in further thoughts is like one real kind of shorthand heuristic summary of a CBDC is that it has a lot of the characteristics and conveniences of cash, um, uh, but without as many of the baggages. That being the cash has certain convenience, but the problem with cash is very hard to scale, right? You can't like carry around. You can't do large transactions in cash. You can't carrying around large. You have to store it somewhere. You know, you're not going to.
I actually have an article where I estimate the weight of $100,000, $1 million, and then $1 trillion. In order to carry $1 trillion, you need 18 truckloads or 20 truckloads. If you could have a wallet, a digital wallet, which in theory you can have $1 trillion on your phone. So, I mean, obviously that's not going to happen, but you know,
it's an example.
There is no,
yeah, 18 truckloads, and so cash you can't really do large transactions. You can't carry large amounts, and if you do, people are going to ask questions. You can't have suitcases full of it, you know. And and there's the safety of it, obviously, the risk of holding a suitcase of it. That's why you have to go to the bank and store it somewhere. And it really only works. It has a tremendous amount of convenience, but it really only works in small amounts. And so it doesn't scale in that sense. It can be used but it's highly accessible. It can be used by anyone. You don't need to qualify for a credit card or even a bank account to be able to use it. What CBDCs gives you is some of that convenience of cash, but also some of the convenience that you get from electronic type money in terms of bank accounts that are ones and zeros that sit on bank ledgers. And then also some of the convenience that you get from blockchain-based cryptocurrencies in terms of resiliency of the system, in terms of at least potentially lower transaction costs because of less intermediaries. So it certainly provides, though not a replacement for all the rest, it certainly provides another option that that will be a good addition to the current rails that are out there, at a minimum. So those. Yeah, next slide. Overall, there's no challenges. Oh, I guess there are challenges. So we've been talking about the benefits, but Vipin, share us about some of the challenges, because it's not all good smelling roses, right?
Well, I think one of the major, two of the major points are number 5 and 6. There's always a balance between surveillance and privacy. Even with cash, you're supposed to declare transactions over $10,000 in the US, and you're supposed to also, when you carry it across borders, declare currency and cash equivalents more than $10,000. They can actually seize money if you did not declare it. But with cash, it can be, all these things can be evaded. So how are we going to do that with central bank digital currencies? One of the propositions is to use tiered wallets, which is for amounts less than a certain amount. Anyone can hold it and pass it around. The other one is the cyber risk security concern, which is when you have a system like this, it is going to be a honeypot to attract all kinds of cyber criminals who want to crash the system, want to issue money without anybody stopping them. But it's a similar problem with cash, because you got to stop counterfeit bills. But the scale and the scope and the speed of it can be very rapid in a digital system. So people, obviously, when we design such systems, we have to be very, very careful. We have privacy at the heart of it, and we have security at the heart of it. And like you said before, I mean, in our private conversations, that it has to be done in a very gradual fashion. Going from
obviously, you're dealing with money. You're dealing with something that is kind of at the heart of what people consider, of where they're going to be, for understandable reasons, very sensitive. And so, just putting on my technology hat, I'd say that, this is a type of thing that you want to really start small and de-risk, whether it start only at the wholesale market, which we'll talk about in a moment, or deal in very small amounts, tiered wallets, and to allay those security concerns and just general concerns on cyber risk. And then there's the entire issue of surveillance versus privacy that is certainly going to be a debate. For understandable reasons, people are not going to want to give up all the privacy of their cash. So one way might be to have it mimic cash is to maybe have complete privacy for small transactions in small amounts, just like you do with cash. But when you go to larger transactions, in that privacy would probably, the security people would probably want, the security concerns would probably kick in just as they would in the normal banking system, as they would in even large transactions of cash. If you're willing to or trying to pull out more than $9,000, I think, from a bank account, they have to file a report on that. You have to, give a reason on why you're withdrawing 10,000 or 9,000 from a bank. So that is going to be a big issue of to what degree do you get privacy versus surveillance. That is itself probably enough for a topic of a webinar. So we'll move on to the next slide here. So tell me a little bit about this money, and this is going to lead to stablecoins. But tell me about this, Vipin, about base money versus broad money, and what you're calling the four prices of money in money markets.
Okay, base money is the money that is directly the liability of the central bank, like reserve accounts in central banks that institutions have, and cash that is used by the public. So in essence, CBDC will be another form of base money that the public has access to. Broad money is where most of the money creation happens, which might shock some people. People talk about central banks printing money, but it is commercial banks that generate money. In fact, the ratio between base and broad money is somewhere in the range of 5 to 6, or even earlier, maybe even 7 and 8. But during the pandemic, that ratio has decreased. But for every dollar in base money, there are $6 or $7 in broad money, which means the banks generate money. Most people don't even realize that it's through loans. And if you go down into the four prices of money, the first one, which is par, where you can exchange one form of money, like the broad money, one form to a base money form. For example, you can take out money from your deposit account and get cash out. But how difficult is it for the system to manage this par price? It's very difficult because there has to be just the right volume of exchange, especially when there is such imbalance between $7 to $1. Obviously, not all broad money can be converted to base money. The other one is interest rate, which is a price of money in the future. The third is exchange rate, that is price of one sovereign money in terms of price of another sovereign money: euro, dollar, dollar, yen, yen, euro, Swiss franc, yuan, whatever you want to call it. The fourth one is the price level, which is the price of commodities. So every one of these has a market and requires liquidity, requires active intervention sometimes in order to keep it stable. Nobody wants huge swings in interest rates, exchange rates, or price levels, and par is difficult to maintain.
I think for me, Vipin, when we met at the conference several months ago, the virtual conference rather, and you spoke to something similar to this about base and broad money, and about most money creation actually doesn't happen by the central bank. It happens by private banks as they issue loans. That's when I knew that you were a guy that knew what you were talking about. and you're a rare species in this field. And I don't just mean the crypto community, even like mainstream columnists in venerable publications, those in positions of influence in academia, columnists, crypto, wherever, that this is something that gets lost, and very few people actually are able to kind of put their finger on this, because monetary operations is one of those really highly specialized and really complicated subject areas and that is that the vast majority of money creation happens at what's called broad money, which is really, or credit money, some call it. And that is when a bank creates a loan, it's simply with strokes of a pen, or strokes on a keystroke rather, ones and zeros, it creates an asset on its balance sheet, creates a deposit liability that sits on its balance sheet, or wherever the balance sheet of whatever bank that the person who took the loan places it. Ultimately, it's going to end up somewhere. So that is the vast majority of money creation or contraction happens in the credit markets, in broad money by commercial banks. And that base money from the central bank, where CBDCs would sit, is a fraction of that. It's well under 50%. Like you said, it's more like 10 to 20%, and it fluctuates. Now, the relationship between, and that broad money, central banks have limited control over. Now, there is, I should say, a raging debate over what degree of influence central banks have over broad money, which we don't need to get into. That's a topic of its own webinar, is raging debate between monetarists and others, but I think the point here is that whatever happens with CBDCs, there is still going to be a critical, important role for commercial banks to play, because there is a misconception out there that CBDCs will end up obviating the need for commercial banks. And I think the point here is that the vast majority of money creation that occurs in the economy, and activity that spurs economic activity, is done by those commercial banks, and would do so even if CBDCs were in place. So I think it's really important that we put that out there, and we address that misconception right up front, that if you float a CBDC, that means you won't need commercial banks. Some people do that as if it's a danger, and other people say that, and that's great, and that's a feature. Whatever you are in that debate, I think our point is that is wrong. That is not a trade-off that CBDCs will bring to the table, whether you consider that to be good or bad. So we do want to move on, because we have more slides of content. I know there's questions coming in. Walk us through really quick this issue of this Venn diagram. It's a great diagram: central bank issued money, digital and money, and then something that is widely available or not.
So in the center of it sits the retail CBDC, which will be central bank issued digital money that is widely available. And adjacent to that is the wholesale CBDC, which are not widely available, only to the institutions, and similar to reserve accounts. There is a split between these two types of CBDC. That's what people think about, because they're only thinking about it with a specific situation that is already existent, not thinking about emergent effects. Like, for example, your argument that we should start small and go big could start with wholesale CBDC and then slowly spread out to retail CBDC. But you might say, why do you need a wholesale CBDC? Don't you have reserve accounts that do the same thing? Because wholesale CBDC will permit a peer-to-peer transaction between the institutions, similar to the peer-to-peer transaction for the retail CBDC. Reserve accounts always need a settlement system which goes through the central bank, the RTGS system. And in fact, they are trying to modernize all these RTGS systems. They need to close it down during certain points. 24/7 operation, it will not be possible. They want to expand that window. They want, Fed is doing that through FedNow. The English are, Bank of England is doing that through the renewal of RTGS program. So there's a lot of activity there, but none of that will be as powerful as the idea of WCBDC, of wholesale CBDC. Anyway, go ahead.
So this is really the interbank market. So that's one place you could start. And just by banks be able to do peer-to-peer transactions on the interbank market, that would still be valuable, for those commercial banks, and there would still be follow-on benefit for retail customers, even without a retail CBDC. And it would also be a way of de-risking, start small on the wholesale market before you kind of roll things out to the retail market. That would be another way to go. So let's move on to this next slide. Just kind of builds on this concept. We add in this other flower here, or this other, you have token and value-based money. So, I mean, walk us
So
through
basically,
this.
these are all beautiful Venn diagrams created by the Bank of International Settlements, and they, just harp on the same theme. If you go to the next slide, you'll see that they go to the specific instances like FedCoin, which doesn't exist, or CADCoin, which doesn't exist, which is for wholesale settlement, and FedCoin will be for now Bitcoin joins the group because
Right
it's
here.
not central bank issued currency, but it's peer-to-peer, and it's electronic, and it's universally available,
Yeah.
supposedly.
Yeah.
And so it's just different ways of looking at it, at this taxonomy of money itself.
Yeah.
And we don't need to, go ahead.
Yeah, what's interesting to me is I look at FedCoin, it's like one adjacent from Bitcoin. It has all the same characteristics, and this is just a theoretical, notional FedCoin. Some people call it digital dollar in the US, and it's mostly, again, at the research level, but they're very similar, except it's central bank liability or not. And then on the other side, the wholesale is a lot like a reserve, except it has the peer-to-peer aspect of it. And reserves is something that exists. So that would be, it's one step adjacent from traditional bank reserves.
Actually, the Fed is engaged in experimentation, and they're calling it Project Hamilton. So FedCoin is Project Hamilton. Interestingly, anyway, let's move on towards the
innovation.
So the Innovation Summit. Okay, I would never expected the BIS Innovation Summit to be focused on CBDCs 1 year ago, but today, more than 60 to 70% of that summit talked about the various aspects of CBDCs, which we'll go into in the following slides. But you can watch that if you just go to that link at the bottom. It gives the link to 2.5 half days or 3 half days of content from the highest levels. People like Chairman Powell, people like Augustin Carstens, the head of BIS, people like Jens Weidemann, who's the head of the Deutsche Central Bank. Everybody's there. Big, and including people from China, PBOC, the People's Bank of China, which is the Central Bank of China. The chairman was there, speaking about the reason why China embarked on DCEP, and which we can see in the next few slides.
Yeah. What's interesting is this is not a CBDC summit. This was an innovation summit, but it was dominated by talk of CBDC. So that's again gives you an idea of where the trends are moving. So let's get into stable coins, sir.
Yeah. So basically, what are stable coins? Why are stable coins necessary? I think stable coins were necessary because there were no CBDCs. Really speaking, they're a way to create a par value pegged to, it doesn't have to be a fiat currency, but normally it is. It can be a commodity, it can be something else, but most of the money in stable coins is tied up either pegged to US dollar or something like that. And of course, it tries to recreate all the functions of money on chain, that is store of value, medium of exchange, and unit of account on chain. Yeah. But unit of account, a question mark, because obviously you cannot buy pizza with stablecoin yet. And it's an on-chain asset, which means right now you can transact directly with your dollars, you deposit it. But the problem with that is it is not the central bank that is issuing the currency, and it is the issuer, either a physical or an enterprise or an algorithm controlled by an enterprise. That is the issuer. So anyway.
I think no, it's not a liability it's a liability issue. It's not a liability of the central bank. So ultimately, it's the faith of you know, and without FDIC insurance, the bank that's the money that's in your bank, this is something as a liability of the bank or the issuer itself, and it may not be a bank whoever's putting out the stable coin. So, you know, ultimately you'll have to trust that they have in reserves pegged 1-to-1. They have dollar-like assets in reserves. If you're talking about U.S. dollar stablecoin, you know, they would have to have treasury bills or notes or dollars, you know, that are highly liquid. But it does give you the convenience still of being able to interact in the way cryptocurrency could interact, but be pegged to dollars, which is what you're used to interacting with. It's what you pay your bills in and what you know, get paid in, you know, in at least the unit of count. So, so moving on beyond this with stable coins, moving on to the next slide here. So implications for retail banks. You know, we talked about this, but you know, what are the implications for retail banks if we're talking about stable coins, but more so CBDCs here? You know.
So basically, they have to. They usually are going to be a channel for distribution of CBDCs, and using CBDCs as a lending channel instead of just having deposit accounts. And there we have to be very careful that there's no, you know, that the broad money does not get kind of capsized by the base money. And then sharing of KYC AML, this is a very important function that these wallets could become something that everyone has, but only attested to by one bank. And there's probably going to be some infrastructure around it and some regulation around it. And, you know, all of these, like, okay, another one is for hosting omnibus wallets. That means instead of me self-hosting a wallet, the bank hosts the wallets on my behalf. And just like they do today in Coinbase accounts or in you know, certain exchanges, they have omnibus wallets. Omnibus meaning everybody's money is inside that wallet mixed together. They have a separate accounting system for your and my money, but in terms of the underlying blockchain, it is custodied by one or two or three, you know, depending on the convenience, but they are all squished together.
Yeah,
omnibus.
We had a question from Professor Joan, and she said, "The president of CBDC, why would anyone keep deposits at the bank?" I think you just answered part of that question right there. Is the issue of custody? There's still the issue of custody, among other things. But
yeah, and also there might be, like we said, tiered wallets. That means you can use it for retail transactions or small scale transactions during a month. You can say you can spend about $3,000 to $5,000 using the CBDC. You know, there are going to be these tiered structures, and they're going to be very careful about the remuneration, meaning the interest rates, so that it doesn't compete with commercial banks. And commercial banks do generate money, and they have to be paid interest for the loans they give, and that's how they make money. But they are regulated. They cannot, you know, not anybody can just create credit. There has to be a balance sheet that goes along with it, and a regulated enterprise has to stand behind it.
Yeah.
Anyway,
there
are many other
webinar. Retail implications for retail banks. I do want to move on, and you know, a basic roadmap for CBDCs going forward. So short term, keep experimenting, right? And you know, and those experiments are happening right now with China, actually, with Jamaica.
There are actual deployments, but they are in smaller jurisdictions. But they are there. I mean, some people say, "Oh, it's not going to happen," but it's already there. Medium term, who knows? You know, maybe more integration system. But a lot of people are experimenting. A lot of people are working together on this. And in the long term, either it will become hugely successful and not discussed anymore. It will disappear into the substrate of our existence, just like cash. Nobody even talks about it. Or it will be a failure, and and there will be more and more pushes to reboot it, do other things with it, create a digital alternative for common people.
Yeah, I want to get to, like, it's interesting that some of the countries that are moving forward tend to be countries that have dispersed population, like island nations you mentioned, because the need for digital payment and cash, like digital cash is very obvious, for island nations, and there's dispersed population. That's a really interesting point. I guess that's
we have these three projects. One is in completion. The other, which is Chinese, it's a much huger economy, and they have their reasons for putting it out there. And then you have the e-Corona project. So because we are almost like at 2:57, so I don't want to hold up the works here with talking about this in detail. But there is a tracker on top. You can see the number of projects that are out there, probably in the hundreds.
Yeah,
if
it's a
you
lot of
click on
material.
that link,
We're going to get on. I think if it's okay with you, Vipin, we're going to stay on we're going to do something unusual. We're going to stay on a little extra because we do have a lot of questions. We'll stand for a couple extra minutes and take those questions, but we do want to get through the remaining material and to be on time there. So, survey of CBDC projects that are out there. Take a look at them. CBDC tracker.
Yeah. And there's a study from March 2020, which is already old, taking stock, which is 80% of the central banks are looking at CBDCs.
Yeah.
And if you go to the next slide, we can probably see, some new ideas, especially about the multi-CBDC bridge, which is for cross-border payments, for climate change mitigation. And then the first one, which is Project Helvetia. It is an interesting project because it's now creating a capital market with a payment rail, which is a CBDC.
Yeah.
Tokenized assets with the payment rail. Anyway, go ahead.
Cool. So these are references, and we're going to switch over, but I do want to take a couple of questions. We're right at the top of the hour here, or 1 minute before, but we'll stay on for a couple extra minutes to take your questions. And thank you for your patience. And God, the vast majority of people stayed on, and we had pretty high engagement here. Actually, probably the highest we've ever had in terms of people staying focused on this. So one question I did have, Professor Lee has asked a lot of questions, so thank you. We may not get to all of them, but he asked, and I had the same question.
If you can forward me some of them, I can try to answer them anyway.
Yeah, we can. I'll ask Professor Lee has asked, his question is CBDC truly peer-to-peer? And I suspect this is going to be a question between various blockchain experts on what defines it. His definition is on a central ledger at the central bank, therefore not peer-to-peer, even if it appears peer-to-peer to the average user. What are your thoughts on that? Because I'm guessing this is a debate between, are permission blockchains really blockchains? Because if it's not a public permissionless like Bitcoin or Ethereum, it's not really a blockchain or not really a crypto. That's a great debate. What's your thoughts on Professor Lee? He's very knowledgeable on all things blockchain. I know him, and what's your question? What's your answer? What's your thoughts on that? Is it truly peer-to-peer? And how do you respond to that?
Well, the point that I want to make is, first of all these things that are called peer-to-peer are not peer-to-peer, because there are still entities that are quite centralized in them. The crypto whales being one of them, who control the liquidity of the market. The other, so I don't want to go there, but let's go back to the question whether they can be peer-to-peer. Look at cash. Cash is a centralized issued currency, but it is peer-to-peer. In the end, in usage, it is peer-to-peer.
Yeah.
So, okay. So how can we mimic that? That should be the aim of these exercises. The Jamaica e-money initiative, the central CBDC that Jamaica is issuing, is based on e-money, e-currency, which is a peer-to-peer system. Now, there can be peer-to-peer systems for certain lower amounts. There may not be any surveillance of all of that, and the surveillance part, so there are two parts. One is the node operators. So if they say, oh, all the nodes are operated by central bank, so it is a centralized system. But that's not going to be the case. There might be all of the participants in the financial markets who are operators of the nodes. There might be the 12 regional Federal Reserve banks in the US that are operators of the nodes. It is very decentralized system compared to the others. And so when I talked to Scott Stornetta, he's one of the few guys whose papers are cited thrice in Satoshi's paper. Okay, no other. There are only 9 references, out of which 3 are Scott's papers. Yeah. Scott Stornetta said, look, this is not, even if a migration from the current system, which is highly centralized, to a more decentralized system is welcome. It's going to be, so decentralization is not a binary.
Yeah.
That's what he was trying to say. He was saying, anyway.
Yeah, I think to Professor Lee's credit, he did not ask if it's truly decentralized. He said, is it truly peer-to-peer? You're right. Yeah, I think we get into questions of decentralization that gets into all sorts of debates. As you said, the vast majority of crypto is owned by a tiny percentage of wallets, and among other things,
well, there is actually
node operators are, but
there's change in crypto. There's change
in crypto. Yeah.
Yeah, which means it is censorable, right? I mean, in the end, even that so-called decentralized system is censorable. In fact, it is censored in the sense that if I get money from somebody who's taken it because of ransomware, I trace it back, or I trace it to a mixer, I can say, I don't want that money. So that, it's not like cash that way. I mean, even cash that has serial numbers, you can actually track it. You can say, so peer-to-peer in the sense, can you censor a transaction that I, Vipin, want to pay you, Anjon, $500. But $500 is quite different from $500,000.
Sure.
Or, so when does the authorities, when do they step in and say, why are you giving me $500,000?
Yeah. Sure.
So I think it's all matter of scale.
Sure, and degree. I mean, there's no doubt you're still. It's still a lot more of a streamlined process, and I don't think Professor Lee, and I will probably speak with him shortly the next couple of days. I don't think there'd be any dispute that it's a lot more streamlined, even if you could have a debate whether or not it's truly peer-to-peer, but which is what he asked, and even if it is not, it is still potentially streamlined in a very significant manner, and so. That's great. And another question, Nur asked, does the Fed have these types of CBDCs in the US yet? I think you'd address that, but there are some ongoing projects. They're not in circulation, but there are projects. I believe the Boston Fed is leading some of that, or much of that.
Yeah, Project Hamilton, like I said, which is a collaboration between the Fed and MIT DCI, Digital Currency Initiative, which is headed by Neha Narula, who was actually the moderator in the panel in BIS on retail CBDC, which I witnessed. And I know her very well, meaning I know of her. I've seen her in many, fora and in conferences, and I've asked her questions about various things. She's very able, and DCI is very, they're very knowledgeable, but they are very crypto focused. So Project Hamilton is probably very, very into the things that Professor Lee was talking about, which is how to have truly private peer-to-peer systems.
Yeah. Richard asked a question. He's asked a couple of ones. Says, why can't CBDCs become broad money in the future? That's probably a big discussion. You get a big theoretical kind of discussion, but I did want to pique your interest on that. Could they become broad money, or is that just by definition not what broad money is? Because broad money is by definition expansion through credit, and as long as there's credit, whether it's CBDCs backing it or something else backing it, it's
well, I mean, forget about the backing part, because that's collateral, right? Collateralized loans. Yeah, but in the end, a credit market is a market. That means the banks have to set the right level of interest, and the lender has to say, I mean, the borrower has to say, this is a pretty good interest rate. I can make more money than that, or invest somewhere and make more money than that. So I'll take this loan because I can take this loan, and they will look at me. And so I don't know whether CBDC enters the picture there. I don't know how CBDC would enter the picture, because CBDC is probably base money. So it can be collateral used in the credit market, but can it be just generated by the banks? Doubtful. Stable coins probably can be generated by banks. Because there can be fractional stable coins. Which is.
Thank you so much for all your questions. Thank you so much, Vipin, for your time here. And just to, I think we're gonna have to wrap things up because we are over time. We want to be, respectful to, our schedule. But just for next events coming up, we have a SIMBA Chain's next 2 webinars. One of them is going to be on media, what we call media verify, which is using blockchain to share, detect, and share altered media. It's a very hot topic, also an interesting use case for blockchain. We're doing another webinar on equity crowdfunding, not necessarily specific to blockchain, but just equity crowdfunding in general for startups and those in the capital markets. It may be interesting for you, Vipin, as a capital markets guy as well. We can talk about that. Vipin will be leading a full-day workshop on CBDCs at a CBDC conference in Dubai coming up this summer. God willing, he'll be there in person because the global health situation will be better. At this point, the plan is to be there in person. And Vipin will be leading that. So if you're at that conference, please check it out. If you're not going to that conference, feel free to let your local friendly central bank or banking staff attend Vipin's workshop. Read Vipin's columns in Forbes magazine. If you want to learn a lot about CBDCs in particular, but just this broad space in general, and you're looking for substance, less so on social media memes and narratives, not that he can't drive those too. I consider him probably literally among the top 2 or 3 best sources that I read, and the best source on central bank digital currencies. And of course, check us out on SIMBA Chain. Please email us. Vipin, thank you so much. Thank you all for coming. Vipin, we'd love to have you back maybe after that conference. Maybe we can do a mini workshop on one of our webinars later this year. We definitely want to have you back again. And that's it. So that's all I've got. So Vipin, I'll say goodbye to all our attendees.
Yeah, thank you. Thank you for attending and being patient. And hopefully we came through with many of the ideas instead of, it's very difficult to know, especially when you're in this kind of Zoom setting or in the web app, this particular remote setting. Otherwise, people would probably boo or throw apples
or cheer.
Or rotten eggs or cheer. But there is a give and take with the audience, which is missing, which obviously can make for very long-winded and boring explanations. But hopefully we have been very on point, and I hope that we'll come back later. And thank you to Anjon.
We're going to have Vipin. We're going to have you on later this year. And that's already been decided. It's just a matter of when. So we're going to find some time. Tell us how the conference went in Dubai this summer, and we'll have you on after that and discuss kind of lessons learned. And I think we're going to have you on an intermittent basis. So, and if anyone's looking for like a private webinar for your organization where we can actually have audience interaction that's just enclosed to a given organization, we're happy to do that as well. pick a topic, let us know. Vipin and I will can be there and help you out, where we can have that kind of verbal interaction and live questioning. Hard to do that in a public setting like this, because you don't know who might come publicly, but if private organization or university wants to do it, we're happy to do it. So that's all for now. Thank you all. This will be posted on our website in a matter of days. Feel free to check it out. Be safe and have a great day.
Thank you.